start to your Thursday. We are going to be talking about rates today, what the situation is, where rates are, and what our recommendations are. On October 15th, we're going to have a great webinar called The Dangers of Linear Markets. This is one of my favorite things to talk about because at the integral kind of core of everything we do talks about price growth over time. And this webinar is going to focus on these linear markets and how that investment model is different from what we do here and how that affects your overall return. We are going to have on October 30th a webinar going over 401ks and how you can put those into action to build your portfolio. These are going to be played at 12 o'clock live and then an 8 o'clock replay. And then November 15th, that weekend, we're going to have a webinar, The Window of Opportunity. This is going to be focusing on rate cuts and your real estate investment journey and how it shapes that journey. And we're also going to be looking forward to 2026 and what we think is yet to come. As always, you can check out all of our webinars on any of our podcast, YouTube channels, Facebook, social media, or send us an email, and we are happy to send you a link to any of those webinars that you missed. I do want to remind everyone that our new North Texas Real Estate Investment Fund is launching this weekend. We are so excited. We had so much success with our last fund. It was just an incredible, incredible opportunity. We're very excited to do it again. And this will be, I think, very, very popular. We've got a massive wait list for our launch. If this is something that you're interested in, please reach out. We'd love to chat with you about that opportunity. This is one of the rare passive investment opportunities that we offer still here in the same market, following the same model with a little bit of a twist on some of the deals that we are able to get on the properties for even better returns. I do want to remind you that we have the live consult webinar coming up in just a couple of months. We are still taking applicants for this webinar. If you are interested in doing a live consult on air, we're probably actually going to do 2 people, but if this is something that you're interested in, please reach out, send us over your information. We'll send you an intake form. We are trying to find 2 perfect fits that are going to be great to showcase how a consult works and how a real estate investment portfolio can be completely transformed with some simple changes. Our next property tour is going to be October 24th. If you haven't booked your ticket yet, we would love to see you on that tour. We're going to be visiting Sherman, Denison, and Princeton, as well as Greenville. So packed day. November 15th, we'll have our next, and then December 12th is going to be our big event weekend. So we'll have the big bus tour. Michael and I will be there, and then we will also have our big party that weekend. So if you're thinking about a weekend to come into town to come see the team and see what we're doing, December 12th is a perfect time to come in for a tour as well. Before I begin, everything I'm going to talk about today is based on my years of experience and judgment as the owner and operator of a real estate investment portfolio, as well as a real estate investment firm. The techniques and the things that we're going to talk about today are what I believe are the right way to invest. We do believe our model is the best, but it's not a fit for everyone. Any investment in real estate could be subject to the loss of capital or amounts invested, and so you want to make sure you do your due diligence on a model, a market, a person, and a product. We have a goal of being one tool in that toolbox for you. And we always, of course, are trying to bring you the most up-to-date information. And we would be remiss if we were not focusing on rates and what's happening right now, because that is so integrally important to the model and how you really time out the model for that 2 to 6 year period. So let's get started. We're going to talk about why you should act now on low rates. Before I jump into the content, for those of you who haven't heard us before, my husband and I have about a $45 million real estate portfolio, and we own a lot of businesses that are all real estate adjacent. Our first and primary business is entering its 20th year. Actually, this month is our 2nd month of our 20th year. And we speak all over the U.S., not only on our unique investment model, but also our very kind of unique and one-of-a-kind approach to property management. We love to educate others on how we built this portfolio that we have in less than the last decade. We are both born and raised here in North Texas, and we are proud to live here. We have 4 adopted kiddos, first grandbaby on the way. We coach and mentor people, and of course, I'm an avid follower of real estate news on not only the local and state, but also national level, and everything that is financial in the financial markets, whether it's stocks, whether it's rates, whether it's politics, whatever could affect the real estate market and investing. That is where I spend my time. What we're going to talk about today are where rates stand right now and where we expect rates to be by the end of 2025, how the current trend of rates spells a prime season for all of us as real estate investors, and then give you some resources that you can use to lock in refinancing. So where rates are at today, we are going to be looking at October 6th, and that is this week. So we're basically looking a couple days in the past. And where we can see this kind of average is somewhere between 6.26 and 7.04 for the last year. And right now we are averaging about 6.34. We're seeing a little bit less than that. But what I want you to be looking at is the range and where we are today, because that's the metric that you want to be using. Rates are currently hovering just about over 6%. And there's been a lot of research and a lot of kind of speculation on what happens when we get below 6%. Now, I will tell you that I'm locking loans right now at less than this for investment that are 30-year fixed. So there's some variance. If you go to a lot of these websites online that tell you where average rates are, you have to remember that's looking at all product types across the entire market, but it's a good kind of average to see where we are. And you'll see that 15-year rates are already down to about 5.55. So again, about the lowest that we've been in the last year. And when we look at, this is from October of 21 all the way to September 22nd. And so this is what we're looking at, about a year period here. And we can see that rates have gone up and rates have come back down, and we're almost to where we were about a year ago. There's some other economic metrics that are important when we're looking at rates. And, you know, what's interesting is despite the government shutdown, despite all this turmoil that's going on in the Middle East and Ukraine, what's happened is stocks are just soaring. They've closed at record highs on the back of the rate cut news and trending futures for the economy. And even with, in some ways, the shutdown, and I could go into a lot of reasons of why I believe that is, but the bottom line is that the S&P 500 hit a new record, the Dow's hit a new record, and the NASDAQ is extremely high. So we're seeing those trends that we want to see to show stability of market. And additional reports are showing that the housing gap here has now approached about 84,000 homes, and it is getting worse. So that's dispelling this myth that there's no longer a housing gap in Dallas, or that it's getting smaller, or a lot of these other markets that we follow. So these are all the different kind of metrics that we're using to monitor on a day-to-day basis to time out when it's the right time to invest, when it's the right time to refinance, where do we go? You know, there's a lot of different things that we're watching on a day-to-day basis. And so let's talk a little bit about understanding the rate shift. As you've seen, mortgage rates are hovering around 6%, and they've even threatened to dip below that mark. And so the question on everyone's mind is, well, when are they going to get below 6%? And the reason for that is because they believe that 6% is going to be that magic number where over 5 million home buyers come off the sidelines. Because one of the reasons the housing market has been kind of stalled is how many people are locked into really, really low rates. And so by hitting the 6% mark, a lot of investors and a lot of home buyers are going to come off those sidelines, because that's the point at which it becomes reasonable and makes sense for them to then go buy a new property or sell their existing. So when will that be? That's the question. So I think that we're probably going to see another drop this year. Some experts are saying 2 more drops this year, yet to be determined where we're going to end. But I definitely think that rates are trending downward. And then, of course, next year, we're going to have some positions in the Fed board that are going to be up, most notably Powell. And so by next summer, I think we're going to see massive rate cuts happening at that point in time. So when we look at the average weekly 30-year mortgage interest rate going back to about 1970, I think this is really closer to 1965, but we're really looking at the last almost 60 years. Historically, rates being lower than 6% or even at 6% is very rare. In fact, when I started really heavy investing in 2017, 2018, prime rate with Fannie Mae conventional loans was 6.25. So, you know, I think the biggest problem we've had the last few years is a lot of people started investing when rates hit 2 to 3%, or bought their first home when rates hit 2 to 3%. And so they have the skewed view of what normal rates are. And so it's felt really high the last year, when in reality, it's extremely average, as you will see. So the wise investor who's been making money off real estate for decades is not waiting for another period of 2 to 4% mortgage rates, because they'd be waiting forever. Very unlikely. I think that we might see in the 4s again for primary homes. I think that with the Trump presidency, I think that's very likely. But I don't think we're going to see free money again. That was a one opportunity time, absolutely incredible. Many of us took advantage of that. And I think that that is something we're probably not going to see again. So the million-dollar question is, what is the smart investor waiting for? And I think the takeaway that I want you to have is rates are trending downward. And as rates trend downward, more people come into the market. This is the same pattern that we saw coming out of COVID, where we saw 30% jumps in a year in values. So obviously, I am all in. I think we've bought, 45 new construction units this year. 100%, I believe the market is about to skyrocket again. So I believe the time is now. now, I think that there really is no better time than right now, because you've got incredible inventory, incredible prices. Rates are already down. We're getting builder, loans right now for our investors on the OmniKey side in the low fives for 30-year fix. So again, I think now is the time. It's the sweetest spot that we're going to see. Again, once rates hit the 6%, the consensus is there's about 5.5 million Americans that are going to enter the housing market. And the vast majority of these are going to be people buying for their own personal use. And so once those extra people enter the market, that means home values will rise significantly due to that demand, especially given the housing gap in markets like North Texas. Competition is going to go up, meaning it's going to take longer for you to close deals. We remember the days of appraisals taking 6 weeks, a lot of cash buyers coming out of the woodworks. It's not that people can't afford to buy. They may not want to afford the payment, but it's that they're not willing to yet. And that's that cusp that we're really starting to sit on the edge of. And then, of course, builders are going to have a lot more business. So they're going to stop offering incentives. They're going to stop offering you these discounted interest rates to investors. They're going to stop selling to investors altogether on a lot of these. So again, it goes back to why right now is a great time. So smart investors want to be buying now before they're facing additional factors. And I think at this point, it's inevitable that the rate's going to drop below 6%. Of course, there's no guarantees. I have no crystal ball, but I believe that wholeheartedly. I believe prices are going to skyrocket. I believe rates are going to plummet. And we're already starting to see the beginning of that. And there is a huge refinancing advantage. When we did properties the last few years, we've been talking a lot about when is that right time to refinance. And we're getting to a point where it really does make sense. Some of my investors are sitting in 7-8% rates. And it really is a very, very simple thing to decide when to refinance when you have a 2% drop. So if you haven't heard us say it before, you're hearing me say it right now. You can always refinance a rate, but you can't manufacture inventory. And so wherever rates are right now, inventory pricing is probably the lowest that we're going to see. Barring another housing crash in the future, it's probably going to be the lowest we will ever see again. I think inflation is here to stay. Hopefully we can get it to 3% or 2.5% or wherever we're going to be able to stabilize at. But at the bottom line is that we're always going to have prices going up. And there's no better hedge against inflation than owning real estate. And so values will continue to rise, in my opinion. So if that's something that you're interested in, you want to learn more about what inventory we have right now, most of what we're doing is about 200 to 220,000 brand new construction, builder rates around 5.25 for 30 years. Incredible opportunities right now, y'all. So if that's something you're interested in, you can reach out to the OmniKey team. They would absolutely love to talk with you about what we have available right now. So what comes next? Let's give some predictions, because I love to say what's coming. What I really think is coming in 2026 is probably going to be what's going to excite you the most. So the National Association of Home Builders is predicting that the 30-year mortgage rate will continue going downward, averaging about 6.25% by the end of 26 and around 6% by the end of 2027. I think they are completely wrong. Fannie Mae is forecasting rates to end 2025 and 2026 at 6.4 and 5.9 respectively, compared to 6.5 and 6.1 in the prior forecast. So you can see they've already trended it downward. And you'll also see that right now rates are already lower than what they're projecting for the end of 2025. I do agree with them that we're going to be in the fives in 2026. I think it's very possible we'll see some fives this year beyond just incentivized rates. And then Bach Financial really have believed that rates are going to continue trending lower in the coming months, and that they move based on expectations rather than the actual decision. And Powell's recent comments have already shifted the sentiment. So what this means is when you hear people talking about the drop in rates is already baked into mortgage rates, what they're really talking about is the rates have already come down before the announcement's ever made, because investors are pricing and basing on what they think is going to happen. So if you ever are watching the news before the Fed announces, the weeks before, they talk about the odds, what investors are betting on. And this last time we were in the upper 90% range that they felt there was going to be a drop. And then they'll also bet based on, do they think it's going to be 0.25% or 0.5%. So at this point, investors believe there's going to be a drop. The people that are making these decisions and pricing their loans believe there's going to be a drop. But keep in mind, the Fed drop is not a direct relation to mortgage rates, but it does translate into mortgage rates coming down. So it's not direct. That's not the rate they're dropping. Now, Redfin said the Fed signaled 2 more potential cuts before end of the year, and Redfin economists expect markets to await further economic data. So they don't think there's going to be any more rate cuts this year. The National Association of Realtors say that they could see a domino effect in the mortgage market, but it's not a one-to-one, and it won't necessarily happen overnight. So you'll notice that if I showed you these same quotes a year ago, they would be very black and white in what they thought was going to happen. But what we are seeing, and often what we do see in a Trump presidency, is no one's really 100% sure what's going to happen. Realtor.com, they believe that rates are going to continue to be in this kind of tug of war in October, and that lower mortgage rates in October versus September are very likely. And we've seen some of that. It's been pretty stable the last couple of weeks. But the real question is, are they going to drop again this year? They signaled potentially 2 more drops this year. I do think there'll be another drop this year. I do. But we'll see. We'll see. Obviously, really strong stock market numbers and other things don't help that. But on the same token, the labor numbers have been moved downward. They've been revised downward. One of the largest downward drops, I think it was like 911,000 in history. So there's a lot of metrics that do make sense for drops to continue. But we also have a Fed president that is not wanting to do necessarily what Trump is asking him to do. So we'll see. What I will tell you is expect a lot of back and forth the next 8 to 9 months until Powell is replaced. But I do believe anyone that gets put in place next summer will 100% be on board with significant rate drops. And so if I were to be a betting person and when I think the market's going to explode, I think that we will start seeing that late next summer. So if you're ready to lock in loans, Daniel is absolutely who I recommend for traditional lending. And he has been working with me for 10 years. He was a huge integral part of me building my portfolio originally. And so he is absolutely who I recommend. Now, if you're going with one of our OmniKey products with a specialty builder that has an incentive program, you will have to go through their lender to do that. So just keep that in mind. Now, for DSCR loans, this is where we really qualify the property, not you. I have seen incredible rates coming out of Gage's office. So Gage actually told me that par right now for his product at 75 and 80% is 6.25 and 6.375. Refinance rates are a little bit higher, but this is rather cash out rates are a little bit higher. But refinance purchase rates, that's the quotes that I've been seeing from him in the last week, 6.25, 6.375. So absolutely incredible. And that is a par rate, meaning that is without a buy down. So if you're looking into a refinance, great thing about DSCR is you also can put it in the LLC. I just did a couple loans with Gage, super easy process, great guy. I absolutely would reach out to him. He's fantastic, extremely responsive, and this is the DSCR lender that we are recommending right now. One of the ways that you can stay up to date on all of this is joining the Wealth and Rentals Facebook page. It's a free thing to join. Tons of experts in there, local and nationwide, giving you data. I'm in there posting data on the real estate market and DFW and all sorts of things all the time, keeping you up to date on what's happening in the financial markets and in terms of rate drops. And then if you're not sure what your next step needs to be, you're not sure if it's time to refinance, whether you should cash out, whether you should 1031, I'd encourage you to book a consult call. They're a great way to have a lot of information thrown at you. We have a huge intake part that comes before you get on the call with me. So I really have a lot of information before we jump in so we can get a whole lot done on that call. And then if you're interested in our mentorship program, you're wanting to really take advantage of the market, you've got assets available to do that, I'd love to chat. And then finally, please do join us on social media. We've got lots of different channels where you can join us and keep up to date on everything that is happening in our market and what we are doing here locally. Thanks so much for attending. I hope you have a great rest of your day.